Good afternoon, judges. My name is Samir Bouillon,
I'm Faiz Noor.
I'm Arjun Bazar.
and today our team is presenting a financial deep dive into Chipotle Mexican Grill. We are from Joseph A. Gregory High School, and we are presenting this on February 16th, 2026. While most consumers know Chipotle for burritos and bowls, from a financial perspective, they operate a powerful 100% company-owned model. This gives them complete operational control and consistent quality across all locations. Additionally, their digital ecosystem now drives over 1/3 of total revenue, positioning them as a leader in fast casual innovation.
Our goal as financial analysts is to answer one essential question: is the burrito boom sustainable? To evaluate this, we analyzed three pillars: sales loyalty, input efficiency, and balance sheet stability. Together, these indicators determine whether the company's recent success can continue long term.
The Food with Integrity ecosystem. Supporting these financials is a unique operational model. Chipotle is 100% company owned, no franchises whatsoever, nationwide. This allows for rapid pivoting and strict quality control. Our digital leadership is also a moat. 37% of revenue comes from digital channels, and our Chipotlanes are driving much higher margins than traditional walk-ins. You might ask yourself, what is a Chipotlane? A Chipotlane is a sort of drive-thru, you could say, but it's for Chipotle, obviously.
Now, let's look at the maturing growth in a saturation phase. Well, in 2025, Chipotle has made $11.9 billion, closing into $12 billion in total revenue. Now, when you look at that, you can see that they had a 14% growth prior, and now they have a 5% growth. Well, we have some critical insight with this. Same-store sales actually did negative 1.7 last year. This tells us that revenue growth is currently being bought through new store openings rather than increased organic traffic at existing locations.
Margins. Chipotle's restaurant margins are at 25 to 27%. Now let's put this into perspective for the judges. The competitors are often at nearly below 15%. This is almost less than half of Chipotle. That's why they are elite unit economics.
Capital efficiency engine. Efficiency is best measured by return on equity, abbreviated as ROE. Chipotle is currently delivering a massive 54.26% on return on equity. In the financial world, 15 to 20% is considered fairly good. Chipotle is delivering over 2.5 times that efficiency, extracting exceptional value from every dollar of every shareholder's investment.
Now, this is the Fortress balance sheet. Now, look at this. We have $9.3 billion in assets, and we have $5.7 billion in liabilities. Well, Chipotle has $5.7 billion in lease obligations, which are good debts. And now you may be asking, why don't they have traditional debt? It's due to Chipotle not buying their restaurants and leasing them. Now, Chipotle is better than most restaurants due to having a $0 traditional debt, and this is why we call them a fortress, because they're mighty.
Fueling the future, cash flow, and reinvestment. The efficiency generates serious cash flow, $2.1 billion in operating cash flow to be exact. Now, you might question yourself, what are we going to do with this money? Are we going to spend it on parties? Are we going to give out bonuses? No, we're going to go in two routes: physical expansion, tech reinvestment. In 2025 alone, 334 new restaurants have been built without borrowing any money at all. Allocation toward AI kitchen tools lowers labor costs, and reward app relaunch happens in spring of 2026.
Strategic landscape analysis. SWOT. The strengths are food with integrity. As previously stated, food with integrity simply means good, high quality food at affordable prices. and the best part of all, zero debt load, as they've never taken out a loan before. And then, as some of their weaknesses, you could say, they got customer budget stretching, which means that customers have to sort of stretch their budget, I guess, due to Chipotle's premium pricing. That kind of piggybacks on McDonald's and Taco Bell's cheap food, this is known as value wars. Value wars are places that compete with, for example, Chipotle, due to their prices as cheaper, as customers would rather buy cheaper. A high growth rival is Kava. Kava is similar to Chipotle due to its same pick your own customizable bowl style, but it's Mediterranean food. And then lastly, we got opportunities. International expansion to Europe and the Middle East is huge. Kitchen and automation and robotics. You might ask, what does that mean? That means basically just reducing labor costs and labor, which is really good for Chipotle.
Now, our verdict. We're going to tell you to hold. Now let's tell you why you should hold. Chipotle is a grade A business at a maturing pace. The stock price corrected at an estimated 30% in late 2025 due to deceleration. Well, what does he mean by decelerating by 30%? It means it has lowered by 30%. Well, you think you should buy it, right? Well, we're going to tell you not to buy it yet. You should wait for the recipe for growth due to relaunches, app relaunches, and AI kitchen tools. This demonstrates acceleration in same-store sales before increasing positions. We thank you for watching this. We hope to answer your questions in Anaheim. My name is Samir Bouillon.
My name is Faiz Noor.
I'm Arjun Bazar.